Good evening, ladies and gentlemen, and welcome to the Center for International Governance Innovation, or CIGI, as we say. My name is Fred Kuntz. I'm the Vice President of Public Affairs at CIGI. Tonight is the latest in our regular series of public events, the CIGI Signature Lecture Series. I'd like to thank CIGI's public event sponsors, 570 News and Wordsworth Books. Thank you for your continuing support. Besides the audience here tonight in the CIGI atrium, we also have a global audience watching on the live webcast available anywhere that has the internet. Following tonight's address, we welcome questions from the audience. Either at the microphones here at CIGI, or if you're watching online, you can ask questions through the live chat function on your screen, and we'll send those up to our panel. Our topic tonight is groupthink and overconfidence, predictive failures in the global economic crisis. We begin with a special guest speaker, followed by a discussion among a panel with two additional distinguished members. And I'll introduce all three of them now. Our keynote speaker is Ruben Lamdany, Deputy Director at the Independent Evaluation Office of the International Monetary Fund. The IMF, as you may know, is the world's premier financial institution with now 188 member countries. The IMF oversees the global financial system from its headquarters in Washington, D.C., and the Independent Evaluation Office exists within the IMF to conduct objective evaluations of the fund's policies and activities, an internal watchdog, if you will. After the financial crisis that erupted in 2008, Mr. Lamdany and his colleague Nancy Wagner led a team of several others to inquire why the IMF didn't see the crisis coming, and more importantly, perhaps, why they didn't warn my broker. That inquiry led to a tough-minded and critical report issued earlier this year, the contents of which Ruben will describe tonight. Moderating and participating in the conversation afterwards is Paul Jenkins, a CIGI Distinguished Fellow. From 2003 to 2010, Paul served as Senior Deputy Governor of the Bank of Canada, where he was also the bank's Chief Operating Officer and a member of the Board of Directors. At CIGI, Paul provides strategic advice to the Global Economy Program, and his own research currently focuses on international policy coordination and financial stability, with a particular interest in the G20. Excuse me, I'm out of breath. And also here tonight is Lou Pawley, who holds a Canada Research Chair in Globalization and Governance at the University of Toronto, where he also directs the Centre for International Studies at the Munk School of Global Affairs. Among his several books, Professor Pawley wrote, Who Elected the Bankers? About surveillance and control in the world economy, a topic sure to arise tonight. However, just like our other two panelists, Lou could also be described as something of a banker himself, having worked at both the Royal Bank of Canada and the IMF. So it is truly a blue ribbon panel of global financial and banking experts, and while they may have considerable justification for doing so, we shall soon see who among the pots is calling the kettle black. And now please welcome to the podium Ruben Lamdany.
Good evening. It's a pleasure and an honor to be here. It's particularly a pleasure for me to be presenting our study on the performance of the fund in the run-up to the crisis at a place directed by Tom Burns, who actually initiated this study as the head and the leader of the IEO. He was still the director of the evaluation unit when the crisis hit, and he immediately said, we need to look at what the fund was doing. And he actually led the beginning of the process and the design. So it's a great honor to be here. My presentation will have 4 sections, which more or less go with the sections of the report that I'm going to be presenting. I'll tell you a little bit about what are the questions that we ask, and I will give you some idea of the findings. Obviously, findings are the biggest part of this report, but I will emphasize more the 3rd and 4th sections, which are the diagnosis and the recommendations. The evaluation focuses on the period from 2004 to 2007. This is when we all may remember the world seemed to be in a period of the great moderation. The world seemed to be in great shape and going to continue like that forever. The study began by looking at 3 discrete activities of the fund, and then we pulled them all together. So first, we looked at multilateral surveillance, which is the activity that the studies that the fund conduct and how it disseminates them on the situation of the global economy. The 2 cornerstones of this activity are the World Economic Outlook, the WEO, and the GFSR, the Global Financial Stability Report. These now are biannual publications, and they get discussed by the board of the fund, and the whole world is aware of that. The second pillar is the surveillance of the fund of the financial centers. In my presentation, I will only discuss the surveillance of the United States, which was at the center of this crisis. And the third is a discussion of the surveillance in all other countries. Surveillance is the activity, by the way, in which the fund studies the economy of a country, or in the multilateral of the global economy, reaches some conclusions about what are the main problems that that economy has, gives advice to the country, and then reports those conclusions and that advice to the international community through the board, and gives the feedback of the board to the corresponding country. I will address 4 questions. First, did the fund identify the risks and vulnerabilities that brought about the crisis? Did it warn the membership about that? 2, I'll tell you something you already know. The answer is no to that question. So, 2, was it possible to do a better job? Because perhaps it was not possible. The answer will be yes. 3, what went wrong? And 4, what can be done about it? So I'll organize the presentation of the findings, which I will try to do relatively quickly, by those 3 pillars that I mentioned before. In its multilateral surveillance messages, the fund between 2004 and even until the end of 2007 had a very sanguine message. The WEO gave the sense that the great moderation was here to stay, and when it talked about a risk, basically focused on only one, which is what was referred to as the global imbalances, which are the current account imbalances between the United States and a few other developed countries and a large number of emerging markets, mainly China. And you probably all remember, because all these discussions were done very publicly. While this was an appropriate message to convey to the international community, since this was a risk, the fund was only focused on that one risk and was not looking at others. In the fund, there were some people, I'll talk about it a little more later, who were focusing on those other issues. In particular, there are some messages in the GFSR. This is not the banner of the GFSR, but you could find here and there in the GFSR a few references to the financial risks. But this was done in such an ineffective and hidden and not detailed manner that left the people preparing the WIO, the board, the international community, more or less unaware and therefore was not integrated into the WIO analysis. Let me just give you a few examples of what I mean by overly positive banner messages. In the spring of 2007, the WIO stated that global economic risks had declined. Spring of 2007. Just to remind you, this is when the large New York banks began collapsing, and it's way ahead of what we saw in 2008 when Lehman collapsed. In 2006, 2005, the messages were even more positive. The GFSR, even as late as the spring of 2007, was saying that the foundations for global financial stability are strong. And the management of the fund in August of 2007, in a public speech, stated that the global economic outlook is very favorable. So looking at all these, and we have access to all the internal documents, we ask ourselves, how could this happen? And we found that there was a very weak coordination between the teams preparing the WIO and those other staff that were looking at financial sectors and were beginning to get, if not in 2006 and 2005, at least by the end of 2007, we're getting an idea that things were not all going very well. There was, in general, insufficient attention to what financial experts were saying in feeding to this global analysis. What did the IMF say about the United States? This is perhaps the most troubling of all the parts of this study. Basically, the fund documents about the United States were presenting as the strengths of the system those aspects of the US economy that turn out to be its weaknesses. Those issues that brought the United States down were presented as its strength. For example, the financial innovation was presented as a great strength, as something that needed to take place faster and faster so as to be able to attract more and more capital. The fact that regulation of the financial sector was very loose was given as a reason for this financial innovation and therefore as a source of the greatest strength. The fund was very sanguine on the possibility of a downturn in the housing market. This was true as late as 2007, when the collapse of the housing market had already begun. Just the housing market peaked in the second half of 2006. On the advice, as I said before, the focus was on global imbalances, of which the United States was one half of the story, and the emphasis was on fiscal policy. When within the fund itself, economists had found that there was very little link between the fiscal position of the US government and public sector and the current account deficits, who seemed to be all due to the lack of savings in the private sector, which were strongly connected to the financial innovations. Again, a few quotes. This is from July of 2007. Fund staff in the Article 4 of the United States said that systemic risks appear to be low, that it praised the Federal Reserve for serving as a guardian against more dirigist temptations, against stronger regulation. how could this happen? Well, we found that, the fund staff found it very difficult to take a position different than the Federal Reserve. And this actually should not surprise us. Any of us would have found that very, very difficult. The fund had 3-4 economists at the highest point in the year working on the United States. You walk into the Board of Governors building a few blocks away, and you have 2,000 economists working full-time. For every question that a fund economist may ask, and he may have or she have a hint of an answer, the Federal Reserve would have 10 economists who have dedicated the last 10 years to work on that. So the degree of certainty that you need to have, the degree of arrogance that you need to have in order to go and contest such people is very high. So this can be understood, but still is a problem for an organization that is supposed to give an independent assessment to each economy. And as we know, it hasn't hesitated to give strong advice to other countries. It is worrisome that when it gets to the United States, even with these justifications, it hesitates. But there's a bigger problem, which is that there is a blind trust, or there was a blind trust in financial markets, in their self-correcting mechanisms. There has been a lot of literature about the fact that financial markets are not necessarily self-stabilizing. But the view that permeated most of the work in the fund was that the system was self-correcting. There were also failures in the internal review process that brought about that people working in the United States were not even including the degree of concern that was shown in the multilateral papers, even though even there the concerns were not very high. What about other countries? Well, the fund was looking mostly about the traditional macro risks and was not really focused on macro-financial linkages. Again, this is somewhat worrying because in the 2 decades that preceded this crisis, there had been several crises that the fund also hadn't predicted. And there had been a lot of other reports that pointed at this issue as critical to be able to see the next crisis. By the way, that was very helpful to us because a lot of what we wrote that people think sounds very intelligent in our report, we just copied from the previous reports. We went and looked at it, and after the Mexico crisis, the East Asian crisis, the Russian default, the Argentinian crisis, a lot of the same issues came up. And there were efforts, but not sufficient efforts. Another thing is that we found that year after year, the fund teams would look in each country more or less at the same issues, even when circumstances somewhat changed. And in some places, that was lucky. The fund did a relatively good job in Switzerland, because every year was looking at that issue, and that seemed to be part of the core macroeconomic issue. In Hungary, it was focused on a completely different issue. And by the way, in Iceland, I don't want to dwell too much on that, but if you want, you can look in our report. Was saying, that things were going great until a few days before a country where the financial sector was several times the size of the economy, and where some people within the fund were saying it operated like a hedge fund. I want to only touch on one other issue, which is that across the board, the fund was recommending financial liberalization to the extent that one would think that was more of a mindset rather than the consequence of an analysis. Because it couldn't be that in every place it would be the same recommendation. And In particular, this was the recommendation for Canada and for Germany, two countries where the fund in 06 and 07 in their corresponding Article 4s was suggesting that they needed to imitate the financial regulations in the United States and England in order to increase the profitability of the banks. I'm sure people here are glad that that didn't happen. Okay, pulling it all together, what did we learn? One, as I told you before, the fund failed to point at the risk and vulnerabilities that brought the crisis. Let me be clear, we're not analyzing whether the fund predicted the crisis. The answer is obviously not and cannot be done. But pointing at the vulnerabilities and the risks that eventually brought the crisis is something that, as I will show in a minute, many people were doing. Second, the banner message until very late was very, very benign about the macro situation. And the focus was on traditional macro issues with insufficient attention to macro financial linkages. All the discussion on risk was on a disorderly and the possible disorderly unwinding of the global imbalances. And financial sector risks, which were pointed here and there, were never brought to the main message. Was it possible to do a better job? My second question, our second question. Well, first, there were many analysts outside the fund and inside the fund that discussed those risks. And second, there were many studies in the fund, some of them from a time in which the transparency policies were not, of today were not in place, that had said the same thing. So even if they're not known to the outside world, they were known inside the fund. I just will go very fast, and I will only point out that the people that we're referring to are not obscure academics in some third-rated university. Some of these ideas were in the BIS, in the ECB, and in major academic centers. So you can see some of these quotes speak for themselves. And some of them were in the financial press, so nobody could miss them. I mean, I can assure you that every IMF economist has an idea of what appears in the Financial Times. More surprising, perhaps, is that there were a lot of people that were concerned within the fund about this. In 2004, the financial counselor, the person in charge of studying financial sectors, began showing concerns about an asset bubble. 2004. In 2005, there were a series of articles and presentations by no one else but the chief economist of the IMF, Raghu Rajan, who had the courage, I would say, to go to Jackson Hole and tell the governors of the central bank of the main economies that he was very concerned, that the financial sectors seemed not to be in the right direction, that incentives didn't seem to be aligned in the right way, and that the consequences of a sudden change in situation could be very dire. Also, in 2005, in the discussion of the GFSR, which was very benign, pointing here and there some risks, there was an executive director at stood up and said, look, I think this is the calm before the storm. Things don't seem to be going the right way. And finally, my last example is that the financial teams of the fund prepare a document for an international consultation on a different topic. More details you can find in the report, where it actually delineated most of the contours of what actually happened. That paper was seen by most of the higher-ups in the fund, but most people thought, you know, this is not the situation and disappeared. Okay, so the overall findings are that the fund failed to warn about risk and vulnerabilities, that the others were more prescient, that the banner message was of benign macro environment, that if there were any risks were linked to the global imbalances, that those that pointed out that other financial sector risks that were relevant were either ignored or their views were relegated to the side. And the big question is why? Why 1,000 of the best economists and the best minds in the world can go so wrong? And I will stick to the IMF and to this crisis, but many of the causes behind this blindness can be ascribed to other organizations and to other circumstances, to the fund and to others. We found three main categories of reasons, and then we studied a fourth and we didn't find anything. One is cognitive biases. That's a complicated word, but for saying that, you look at the world and you are so convinced that you know what is going on that everything that happens supports your views, even when it is the opposite. This is a typical behavior of a parent. Happens to me all the time. They tell me, my children have done this, and I put it exactly in the same, for better or for worse. Usually, in my case, for worse, but I put it in the wrong drawer. I'm sure we all do that. The second is problems in the governance, and the governance at the high-level governance of the fund and the internal governance of the fund. And the third are analytical weaknesses. The dog that didn't bark were the political constraints. I'll say about that in a minute. Okay, on cognitive biases, let me go very quickly. We found that there is an intellectual capture. The fund in advanced economies tend to tell the authorities exactly what the corresponding central bank tells the fund. And this is not, sometimes you need courage for that, because you go and tell a minister that you agree with the central bank. That's not always easy. But it's also not always true. And that's a problem. In this crisis, this is most clear with respect to an intellectual capture by the Fed and by the Bank of England. There were also blind spots. The fund staff could not conceive that a crisis could happen of this magnitude could happen in an advanced economy. This is a strange thing, because most people in the fund spend most of their life looking at crises that look more or less like this, except in developing or emerging markets. But when you decide that something cannot happen, you see it and you don't see it. Finally is groupthink. Groupthink is a funny thing. Is that economists in the fund feel more comfortable with people that think like them. And feel very comfortable not making waves, not picking fights, not antagonizing their bosses, not antagonizing their colleagues. Very unusual. None of us, I'm sure, feels like that. Groupthink is the most common behavior one can imagine. As I told you about confirmation bias before, about tending to always putting stuff in the right place, it's very difficult to change groupthink, because it's not human nature. You cannot just change people and hope that you will not have groupthink. You have to create a system in which you have tensions to avoid this. Because you have to create those tensions, because otherwise, we all tend to move in that direction. On the governance and organizational issues, we found that it was very unclear who was responsible to connect the dots, who would be accountable for making sure that the fund looked at all aspects of an issue, who will protect the staff if it stood up and told a message that important authorities didn't want to hear. Because, you know, it takes a lot of courage to go and tell the governor of a central bank or the minister of finance after you have visited their country for 2 or 3 weeks that they have it wrong. And these people didn't get elected by being very, very nice to everybody that opposes them. So it's difficult. We also found that there were enormous incentives to toe the line, to conform to the prevailing views. This is also common in many places, but I think this is easier to change than the psychological problem of groupthink. And we found that the fund operated in silos, and there were turf battles. But this is so unusual. I'm sure nobody has ever been in an organization that has these problems. But again, there is a problem here that is hard to solve, because silos are a very efficient way to producing widgets. You know, Henry Ford made a fortune by creating silos that produced those widgets called cars. When you're producing homogeneous goods or services, silos are very good. When the world was always going in the right direction, these silos were okay. It is just that silos are not very good to find out something that is not within your own perspective. If you're not listening to what others are telling you, listening to others is very time-consuming, but it may save you from keeping with the same message when the situation has changed. And finally, we found a great insularity in the fund. In the next couple of weeks, we will be issuing a report on the research of the fund. And there is the easiest to see, because there you can count citations. The fund tends to cite its own work, even when there are others that have done, you know, serious jobs about that. Finally, on the causes, we found that there were some analytical weaknesses. First, like the whole profession, there was very little emphasis on macro financial linkages. I mean, the profession is not very good, or is much weaker in the interlink between the macro and the micro, between the financial and the macro analysis. The fund had done some efforts, but did not do enough. And there were all kinds of studies that were being done on how to apply the balance sheet analysis, studies of the EFSAP, and they're not well integrated, or not always well integrated into the analysis. The dog that didn't bark, or that barked kind of quietly, and that's political constraints. When I began working on this, I thought, you know, I'm going to find that some people went and tried to tell the US authorities, the UK authorities, and others, there is a lot of problems, you need to have a tighter regulation, you need to ask the banks to be more careful, to have greater capital. We found nothing. we did a lot of work on this direction because I'm very stubborn and I was sure that this was going to work, and it didn't. We did find some other related issues. We found that on fiscal issues, which are not really connected to this, there was a lot of pushback in certain countries where the staff had said, you have serious problems. The authorities said no. The staff insisted. The authorities went above their heads and got them moved out, and their careers somewhat derailed. Now, that has nothing to do with the causes of this crisis, but that generates fear, and fear is a very powerful feeling. If, after I see this happening, if I begin thinking that there is some other problem, I might find some mechanism in my mind to erase it so that I don't have to deal with the question of whether I'm going to say it or not. So this is more an hypothesis of self-censorship. Some people in the staff of the IMF told us, you know, we know how this works, and therefore we don't go and explore things that may give bad messages. Now, that's a very serious problem. And the solution cannot be to ask the staff to be more courageous, which wouldn't help because they would be fired in any case. The solution is that the authorities, the owners of the IMF, the people that elect the managing director, the people that run the board of directors of the fund, need to agree that this behavior is unacceptable, that with the necessary constraints about not creating a crisis, the staff should be allowed, protected, and encouraged to bring difficult messages. In sum, no clear messages, other words, more prescient, groupthink and intellectual capture together with governance and analytical weaknesses were the main causes behind the failure. I hope that I gave you a sufficiently balanced analysis of the causes to leave you in despair, that there is nothing that can be done. I'm going to try to correct that, but I hope you realize that I will only correct it partially. There are things that can be done, but they are difficult. There is no easy solution for this. It's not by chance that this is not the first crisis that the same factors come to play. The IMF has already put in place many initiatives to address some, mostly of the technical issues. But these changes are not enough. The issues, as I said, are complex, and many of the weaknesses that we identified here were identified in the past. And many of the reforms that we are suggesting, we just copied them from all the reports. So what is needed is a decision by the membership, by the authorities, by the board, by the management of the fund to work on all these issues. We identified three main clusters of areas to change. Governance changes, changes to bring that promote openness and candor within the fund, vis-à-vis the authorities and for the whole international community, and improvement in the analytical frameworks. On the governance, as I mentioned before, there is a need to clarify the role and responsibilities of the board, management, and senior staff on who is responsible for connecting the dots, who is responsible for protecting the staff when it says something that upsets the authorities, and who will be held accountable and how. Perhaps the most difficult governance change that needs to be done is to recalibrate the IMF approach to risk assessment. To make it clear, the fund tends to call too many risks in low-income and emerging markets, and too few risks in the advanced economies. So perhaps there is a need to recalibrate this. The view that all risks come from emerging markets has proven to be not true. So perhaps using the same type of magnifying glass that is used in the emerging markets, in advanced economies, and using the same type of rosy lenses a little more often in the other countries may yield a better result. On the internal organizational issues, we talk about strengthening the review process, and we give some ideas on how to overcome the silo behavior, which is more about the incentives to collaborate. On promoting openness and candor, we have recommendations at 3 levels. First, encouraging diverse and dissenting views within the staff. Second, creating incentives that will allow people to speak truth to power to the authorities. And the third is to give a more consistent message in the multilateral surveillance. Within staff, since I mentioned before that this is very difficult and people tend to move, we think that basically what you need to do is to bring outsiders, to create noise, to create tension. And we suggested 2 ways of doing that. One is to bring outside analysts to report to the board from time to time on how they see the world. And 2, to create a unit that is dedicated full time to do this type of risk assessments, risk identification, and that reports directly to management. On speaking truth to power, we thought about the idea of staff reports going straight to the public without first having to be discussed at the board and approved by the board. Because one of the problems now is that the staff doesn't write for the outside audiences, it writes for the board and writes what the board would like to listen, to hear. Because the best thing you can get as a staff member is for the board to say that they broadly agree with you. So that's a perfect incentive to write what the board wants so that they broadly agree with you. And we recommend that there should be a fund-wide self-assessment of the institutional health of the fund on a periodic basis. This is something that's been done in many other organizations, and that has helped many organizations detect risks that were not seen otherwise. We have suggestions on how to make the message to the overall international community more consistent. One of them is perhaps the creation of a single surveillance report. And we have suggestions on how better to integrate financial sector issues into the macro analysis, beginning with giving a more important role to the financial experts in the conduct of the Article 4 of the main work of the fund. These are some of the ideas that we put on the table. This was commented by the staff, by management, and by the board. Basically, the staff, management, and the board agreed with our analysis, largely with the diagnosis, and agreed that while many things were already taking place, much more needed to be done. And in fact, the managing director, in his comments, pointed at several of the issues. It's a subset of where we think there needs to be further progress, but put in place a lot of movement and things are moving along. The board, again, endorsed many of our recommendations. In fact, endorsed all the big recommendations, all the problems. But at the same time, and this is the third bullet there, told us and told the staff and told the international community that you need to be realistic in what you can expect from IMF surveillance. That's not very encouraging with respect to getting big reforms done. Our reports get discussed by the board. Some of the recommendations are endorsed specifically, others are broadly endorsed. But then management has to prepare an action plan, which gets discussed by the board. That second stage has already taken place. And there was a broad agreement among the members of the board of the fund that these are very difficult issues that need to be studied further. And there is a triennial surveillance review that is studying by the staff, is studying what has happened in the last 3 years, which includes the period that we're dealing with. And that will be finished by the annual meetings, September, October. And so much of the action plan has been put for now on hold until the staff concludes its own study of this. I hope you found this not only interesting with respect to the fund, but perhaps also useful to understand your own organizations. Thank you very much.
Thank you very much, Ruben, for really an excellent summary of the report. The IMF, as you all know, was very much at the center of a lot of these issues, and the global financial crisis is still with us in many respects. And the work of the Independent Evaluation Office is important, I think, for any organization, particularly an organization as important as the IMF, that they have a review process, an accountability process, if you like, the need to be self-critical. And this report, I think, looks at the issues and provides a very good summary from that perspective. I'm going to now ask Lou Pauly to share his thoughts with us on this range of territory, and it is broad. But Lou has written extensively on global governance, monetary and political issues, including issues relating to the IMF. And he's also focused much of his work on what I call the changing world order, which is in some respects a sub-theme of some of what Ruben has been talking about. So before opening it up to a discussion amongst the three of us, I would really like to, Lou, hear your thoughts on what Ruben has said, but your reflections more generally.
Okay, so, Paul, thank you very much, and thank you, Ruben. This is a very admirable study. It's accessible and easy to read. Let me talk about some of the details, but after putting it into a slightly broader historical context, because I'm assuming, since I know all the people in Canada who are really interested in IMF surveillance at a level of technical detail, and I know that they fit in the front row here, I think it'd be useful just to put
we want them to stand up and identify themselves?
Just to put Ruben's project into context. This surveillance tool is, in my opinion, and I think it's shared by my colleagues here, important. Now, we Canadians, by the way, I came to Canada in 1978 the honest way. I married a Canadian. I was born in the United States, and you need to know that for something that I'll come to repeatedly in just a couple of minutes. The surveillance tool emerges in the mid-1970s when the fund's original articles of agreement basically and the Bretton Woods order that it stood for broke down. But it had its roots in a function that continued in the fund, continues in the fund from beginning to now. In the old days, it was called the consultations process. But most IMF staffers don't know or they've forgotten, that that function itself had its antecedents in the League of Nations before that. So there's a long history here, but there's a theme I think in the middle of all of that history, and that is the world needs a tool to effect a compromise between two things: the principle of economic openness and the practice of political autonomy. We needed both, we wanted both, and why? Now, I don't see anybody in the audience who can remember, actually, in their own lives, why. So we need reminders, and certainly I don't expect any of the young faces in the audience to think that this is anything other than ancient history. But I think to understand it is to understand Ruben's subject. Look, economics was to reinforce security in 1946 when the fund was established, formally established. Military security of the most basic kind. To be sure, a stable security architecture was to underpin economic growth, but it rested on a fundamental and broadly shared historical observation. Now, war has always been a feature of human life. Our Prime Minister now is seeking to end Canada's involvement in one war that continues in our day. But catastrophic systemic war and systemic economic decline appeared in 1944, the Bretton Woods Conference, and still appear today to be fundamentally linked. Economists can argue about which way the causal arrow goes. I think the basic observation is that catastrophic systemic war and systemic economic decline coincide. Economic decline didn't always cause catastrophic war, but the association was strong. After the dawn of nuclear weapons, fastidious academic debates were unnecessary. Economic prosperity, broadly and deeply shared, was perceived by the great powers, by Canada and the United States in particular. Canada was a leading voice at Bretton Woods. The great powers in particular perceived economic prosperity to mark the main road away from barbarism, away from the military cemeteries that still litter Europe and Asia, and away from Auschwitz. The fund was to be but one vehicle propelling humanity down this better road. Now, despite one flat tire after another, despite broken axles, despite periodic engine overhauls, the IEO is involved in analyzing all of them. Are we really prepared to abandon the vehicle? I think that's the question we face today. The IEO's penetrating critique of the recent failure, which is, as it states in the study, just one in a long line of similar external and internal reviews of fund surveillance in practice. Frankly, such criticism should be taken as a sign of institutional health, in my opinion. Human beings operating in institutional settings are complicated creatures. Self-criticism is a good thing, as long as it's not overdone, and as long as it's not done to the point of delegitimating its target. I think it's a good idea. It calls us, frankly, to our better angels, despite the knowledge that inner devils and a nasty external environment remains. This is such a great and lucky country. it's hard to imagine that a hostile external environment is out there and that our current prosperity could break down. But wasn't that what we were all thinking in August 2008? Vividly. Now, I once characterized the institution of IMF surveillance in the following terms. There's a few professors here and a few students. This is the way I thought about it. Like an academic department comprised of tenured colleagues who do not necessarily all enjoy one another's company, but who soon come to realize that some minimal level of compromise is in their personal interest. The actual process of monetary collaboration in the continually reinvented Bretton Woods order, which I think continues to this day, depended upon the existence but not always the effectiveness of an administrative entity. Like a department chair, the fund's own autonomy would always be limited, both constitutionally and in evolving practice. It would, however, have to stand for certain principles. It would need privileged access to knowledge that could not be fully shared. It would have to be endowed with the legitimate authority to mediate and adjudicate, the technical ability at best to forestall and at least to manage crises, and in principle, if not always in practice, the capacity to sanction. Like a department chair, it could also continually have to defend itself against charges that it had exceeded its authority. But for the fund's central role to remain acceptable in a world of open and integrating markets and still sovereign polities, still sovereign states, its behavior would have to remain consistent with an underlying and broadly shared sense of the rightness of its prescriptions, which in turn have to be deemed universally applicable, at least in principle. Now, in practice, the task of defending and deploying the fund's delegated authority would never be easy. The actual power of the fund would always remain ambiguous and variably applied. Nevertheless, the normative foundation of the fund's core mission suggests an historical discontinuity with what went before. The discontinuity with the era of 1914 to 1945. We have not recapitulated that. The fund doesn't deserve very much credit for the fact that we have not recapitulated it, but it deserves a little bit of credit. Helping to prolong the condition underpinning our security remains the fundamental purpose of IMF surveillance. Now, as the editor of a journal called International Organization, I like to recall the first article on the fund published in the journal in 1948. A pioneering political economist by the name of Klaus Knorr noted that the fund was designed to help restore an expanding world economy. Seemed obvious at the time. But he also argued that the dearth of global liquidity was then still too severe, commitments to freer trade too fragile, and political crises too deep. So he concluded that the fund and its sister institution, the World Bank, might here and there be able to relieve temporary maladjustments and channel funds into deserving projects. But they must not be underrated as facilities for continuous consultation. Will they become vital underpinnings of a prosperous world of multilateral exchange? Knorr asked at the time. His answer was clear. By their own efforts, these institutions cannot bring about such a world. Well, so we're today, in Ruben's study, we're looking back at the world as it has developed since 1948. Although Knorr's essential question remains open, economic prosperity beyond the scale envisaged 60 years ago is a fact. And the autonomy of ever more interdependent states is even easier to discern in theory than in practice. The world economy that greater openness has produced remains fragile and full of injustice. But it's hard to imagine the architects at Bretton Woods being entirely displeased with their legacy. We have a responsibility to them to keep it going, it seems to me. A normative consensus on the political value of economic openness ultimately propelled the fund to a more prominent role than many expected it to have in the late 1940s. At the same time, though, a collective repudiation of the fund could still occur, perhaps occasioned by a catastrophic crisis like the one we almost had in 2008, by unchallenged currency manipulation, or by a system-changing shock beyond the capacity or the will of even cooperative states themselves to address. More readily imaginable, perhaps, is the fund and its surveillance mandate withering away quietly, because not enough people will have read this report. Eroded by a formalism divorced from meaningful policy impact, partly by the hubris of economists and their own self-isolation from other disciplines, but also, more importantly, by the gradual displacement of new global structures built on sand. The GX process. I hate to say that here. We could return to it. I know this is sensitive territory in this building. Skeptics would have us believe that we should and could start again from scratch. Today's Financial Times, a famous economist who actually was here the last time I was here 18 months ago, has a column proposing exactly that. I think it's romantic dreaming, a flight of fancy, perhaps just as dangerous as the outrageous greed, corruption, and lack of self-discipline so obvious today inside the halls of political power and in financial markets. No responsible political authorities ever wanted to become casinos. Those casinos emerged from the competitive impulses of great powers and vested interests within them, and the underlying greed and corruption that we now see absolutely clearly, looking back at the 2007-2009 period, 2011 period, are obviously irrevocably woven into the fabric of human society. Too weak at the moment are the countervailing cooperative impulses of the great and nearly great powers that could and must restore a better balance. Do we imagine that those impulses have a better chance of re-emerging in a world without legitimate, universal, multilateral institutions, without reliable mechanisms for crisis management and monetary and fiscal burden sharing, and practically speaking, without permanent and competent full-time staffs? I certainly do not. The task is urgent, and here's my specific hope. I trust not entirely unrealistic. The United States, which is the 10,000-pound gorilla at the core of this study, the United States can begin to discipline itself. The United States and European shared interests in regional and transatlantic stability can once again trump all too obvious problems. The missed opportunity of 1949 can be retrieved, and China can be brought fully into the post-1945 world order on the basis of mutual respect. Reasonably well-regulated and supervised markets, especially financial markets, and shared commitments to environmentally sustainable economic growth can sustain middle powers and bring rising prosperity to the rest of the world. And finally, a sound global economy can continue to reinforce a stable global security architecture. Ridiculous? Naive? Does anyone have a better idea? If not, and you get your chance in a minute. If not, after yet another period of post-crisis self-criticism, let's get on with the business of improving the tools we have at hand to realize that idea. Tools like IMF surveillance. Thanks.
Okay, thank you very much, Lou. Well, we've got a richness of issues here to discuss, and I certainly want to leave time to engage the audience. But why don't we continue with this surveillance theme, since you've spent a considerable amount of your presentation on that, Lou. On the one hand, Ruben quite clearly indicated that the surveillance process in the U.S., because it didn't identify the risks and vulnerabilities, it didn't connect the dots, that there are difficulties with the surveillance process. It needs to be strengthened. There's the analytic weakness, and I'd like to come back at some point to this groupthink issue. So there are these analytic issues, the failures of the surveillance process, whether it's bilateral or multilateral, the issues that you talked about. But I would say more generally, and maybe this is counter to your sentiment, Lou, but my view would be that there has been a lack of acceptance of the surveillance process within the IMF context, that at times the objectives of the surveillance, whether multilateral or bilateral, have not been clear. There's been the view by some that the surveillance process has been biased towards the advanced countries, and that there are big gaps in the surveillance process, particularly with regard to spillover effects and the interdependencies that are now so evident coming out of the global financial crises. But another element to this, it seems to me, I'll call it accountability, but it is this distinction between countries that are borrowing from the IMF and those that are not, which again may be part of some of the views around the biases that some people feel do exist. The role of the IMF very much originally designed to be a lender to help countries adjust to external balances. One thing that the report did not get into, and this really is where I'd like to take the discussion, and it didn't get into it because of your time frame of 2004 to 2007, is a new innovation that really has come out of the G20 process, which is the mutual assessment process, MAP as it's called. And it's different. It's part surveillance, it's part peer review, but the idea here is to collectively look at the challenges facing the global economy within the G20 process and to assess the policies of each country and whether or not they aggregate up to something that is consistent in terms of promoting economic growth and sustainable economic growth. So my question that I'd like to pose to the two of you, if we can move the time frame forward, Lou, from your perspective and your importance, as you see it, for surveillance, and Ruben, your reflections back, is this mutual assessment process the way forward? Is this something that is truly different, and does it hold out the prospect of actually moving things in a way that will actually help overcome what we've seen so far? So,
I'd be interested in that.
Okay, let me start with you then, Ruben. Your thoughts on that?
Thank you, and thank you for your presentation. I just, if it wasn't clear, I want to reiterate something that is at the introduction of this paper, which is that in our view, the need for the fund is greater today than it has been for a long time. An effective, a legitimate IMF. But if the IMF did not exist, it would be a very good idea to create an organization that can help discuss and coordinate policies in a multilateral basis. So this is to strengthen your point. It just,
unfortunately, it takes a systemic war to create such institutions. Right?
We respect, well, it took. I don't know if...
Well, we created the League after World War I. We created the IMF after World War II. If really...
I'm too young for that. I didn't create it, but...
Okay, but this mutual assessment thing, part of the GX process and the connection to the IMF, I'd be very interested in.
I will be doing a lot of commercials for our other work. For a start, I recommend background papers prepared by Sanjay Dar about the work in the United States of the fund.
Yeah.
by Angana Banerjee on the multilateral surveillance, by Nancy Wagner about all the other countries, and a study dedicated to the governance of the surveillance by Biagio Bosone in an earlier evaluation of the IMF, which was also spearheaded by Tom about the governance of the IMF. In order for surveillance to be effective, it needs to have not only high quality, but has to have a high degree of legitimacy. It is true that the G20 has a higher degree of representativeness than the G7, than the G8, than the G9, but the fund is a universal organization. And whatever degree of legitimacy it has, even in its times of weakness, even when it fails to do its job in an effective manner, comes from the fact that it's a universal organization. The G20 right now has some aspects of its work that seem to be more efficient and effective than the process within this universal organization. But lack of legitimacy eventually erodes effectiveness and relevance. It may take some time, but we have seen it happening.
Yeah.
Countries develop faster than others, and suddenly the G20 needs to have change its constellation, and it's very difficult. So that's the beauty of a universal organization, where, in theory, every country can have its voice. Now, those people that were creating the G20 process, I think were somewhat aware of this, and that's why they made room for the IMF to play a role in the mutual assessment process.
Lou, what are your thoughts?
The dream after the war was that economic growth and prosperity could be monitored by a technical staff that would be outside politics, would be separate from politics, would be neutral, and perceived to be neutral, and therefore their advice would be accepted. Well, you know, that was a great dream. It just didn't work. It was not realistic from the beginning. However, we shouldn't jump from that observation to saying we should stop trying. What we should realistically see is the need for a permanent staff trying to get away from groupthink, to give as neutral as possible a body of advice, which can then be accepted or rejected. Is that not better than no criticism at all? Is that not better than, let's say, a temporarily assigned staff, such as we have it in the GX processes and in the Financial Stability Board? 16 economists who come and go. Talk about how would they ever begin to even think about combating groupthink if they're not in place for longer than two or 3 years, if there's not institutional memory behind them. All right, so the need is to be realistic about what this tool can do, but then step back a little bit. Look, we all know what needs to be done right now, and we all know that if we don't do it, we're in big trouble. The U.S. needs to get its fiscal house in order. Everybody knows that, and I think there's a broadly shared consensus in the United States about that very reality. I think the vast majority of Americans are outraged by the condition of their financial markets and the corruption that's all too clear at the core of it. The issue is, inside the U.S. political system, to effect the necessary changes. Can they do it? Yes, they've done it before. Will outside technical advice help? Why not? It helped us 15 years ago. Mr. Martin used the tool of surveillance advice. He didn't necessarily, the fund didn't come into Canada and say, remember, some of you are old enough to remember this. I certainly remember. Eric is not old enough to remember, but I remember. 15 years ago, Mr. Martin told us this country is on an unsustainable trajectory. We have to get our fiscal house in order. We have to get our debt levels down. We have to do something, or, he said, partly for effect, but it certainly worked, or the IMF will come in, and it will have to borrow from the IMF, and then the conditionality tool of the IMF will come in, and they'll actually be able to tell us what to do. Well, frankly, for a great power like Canada, that was never really plausible, but it gave Mr. Martin and Mr. Chrétien enough political cover to do what they needed to do. We all knew they needed to do it. We gave them the space. They did it. Our prosperity today is a direct result of that. Is fund surveillance unrelated to that? No, it's not. Okay, now our experience 15 years ago, couldn't we have that experience in the United States today? Couldn't at least some pressure coming from, yes, the GX processes, from the Financial Stability Board, but most importantly, a multilateral institution in which China is an intimate member, couldn't that at least help a little bit? Yes, it should be able to help a little bit. In any case, the U.S. has to get its house in order. The Europeans obviously have their issues to deal with. Are they being helped by the existence of fund tools today? Absolutely yes. Anybody who's following the crisis unfolding before our eyes in Europe knows that the fund is playing a role. Partly the surveillance tool, but also the conditional lending tool. Very important. Even inside Germany, it's perceived to be very important. They don't want to do it themselves. It's a burden-sharing mechanism. Okay, now then we turn what needs to be done in Asia. Everybody knows what needs to be done in Asia. The idea of these mounting foreign exchange reserves based on essentially mercantilistic policies and excessively export-led development strategy. These things are not, well, let's just say they don't give us comfort, all right? These issues need to be viewed together, and they need to be viewed together in an analytical context that's as reasonably neutral as possible by competent people who do not have, who are, let's say, a little bit more aware now of the temptations of hubris. It seems to me that since these are all humanly created dilemmas, humanly created tools can help us address them. In the absence of those tools, would our independent states, which are still very competitive with one another, would they solve these problems through some kind of automatic process? Some people believed before 2008 that that would be the case. Mr. Greenspan believed that would be the case. He was proven absolutely wrong. There's nobody out there to help us. We've got to help ourselves.
I think one of the issues that ties these various points together is indeed what I would call the growing complexity of interdependencies. And you mentioned the U.S., but in the same breath you mentioned China and suggesting that everyone knows what needs to be done. Well, maybe everyone doesn't know what needs to be done, or at least not everyone has accepted what needs to be done. And I think this is where the mutual assessment process does hold promise. To me, one of the critical lessons of the global financial crises is the fact that what ties countries together is now more complex than we had thought before, and we need to understand those interdependencies. We need to understand what ties countries together so that we get the policy coherence that's needed. And this isn't to argue G20 versus the IMF, but it's to argue that the mutual assessment process is a process that is different, that does enable some aggregation across countries of policies to help guide our thinking in terms of what is the best outcome that can be generated through this coherence of policies. I would like to, if I may, just...
But Paul, why not do that through the executive committee of the IMF? Why do we need something new?
Well, I think what we need are new tools. You can call surveillance a tool, but I don't think we have the analytic capabilities that actually identifies yet the degree of complexity of these interdependencies. And it comes to the spillover effect. I'll give you an example, Lou. I'll give I wasn't going to do this right away, but I'll give a little bit of an advertisement to a study that recently came out from CIGI with Chatham House on this whole issue of global interdependencies. And you can pick up a copy tonight, or it's on the website, CIGI website. But one of the elements of this report is the recognition of these spillover effects. So just to give you a simple example of what we have in mind, you mentioned that the U.S. needs to get their fiscal house in order. Absolutely, I fully agree. The Congressional Budget Office does very good analysis, independent analysis of different projections of U.S. fiscal tracks. To me, it would be a huge step forward if the CBO were also, in addition to presenting these different budget tracks in terms of their implications for the U.S., to broaden it out to actually say, what are the implications for the global economy? Use some of the models that exist at the IMF so that China, Canada, Europe knows what these different tracks might mean, and you begin to develop a higher level of understanding of these spillover effects. And so that is part of what I think needs to be done. We need to enhance our analytic capabilities. We need to raise the bar in terms of individual countries thinking more about their policies from this international spillover effect. So I don't see that being done by the executive board. I see the IMF staff playing an important role, some of that flowing up through the executive board. But it's a change of mindset that I think is needed here because of these interdependencies, these growing complexities, both on the real side and on the financial side. But if I may, I'd like to move to this groupthink issue because it's tied in exactly to what we've been talking about. And in many respects, it seems to me there are two aspects to it. One, both of you have touched on it, which is the notion that markets are self-correcting, the light regulatory touch, which proved to not stand the test of time. But the other...
We never believed that, right?
Pardon me?
We never believed that.
Well, we can come to the Canadian experience in a moment, if you like, in terms of the difference in regulation here versus elsewhere. But the other element of the groupthink, it seems to me, is from within the economics profession itself, where in the report you talk about these various models, the DSGE, which is the Dynamic Stochastic General Equilibrium model. You don't all need to know what that means, but it has very simplifying assumptions, which on the one hand are important to help you use these models, but some of those assumptions clearly did not capture what actually happened through the global financial crisis. So my question is, how do we move our thinking forward? How do we change the way we approach analysis within the economics profession? So it's partly regulatory, but it's partly also the tools and the paradigms that economists have been using. So what are both of your thoughts on how to change that groupthink? What is needed to move our thinking forward in terms of new economic thinking?
On the technical side, the fund and others have embarked in new initiatives to make the tools more amenable to the crisis that already happened. The crisis that already happened, no, perhaps the next. A lot more research on macro-financial linkages, incorporating into the DSG models financial sector models. I didn't want to go into that because I'm not sure if the whole audience knows what this is. The fund conducts a vulnerability exercise which before the crisis did not cover advanced economies, and now it has been incorporated. So go and look for those vulnerabilities that before were looked at only in emerging markets. There is an early warning exercise that is being conducted with, war games and modeling. So the fund is moving on the technical part in the direction of identifying the risks that brought about the last crisis. Our concern, we welcome the report, the IO
Points in that direction.
welcomes all these things. But we're concerned on two grounds. First, the focus on the battle that already took place. And two, that this is basically the same issue. It's all technical issues on one aspect. What if the next crisis, who knows, comes from the fiscal issues? And there you could have groupthink, intellectual capture, you could have a confirmation bias, you could have the same problems. So that's why we recommend processes that will stir up the pot, processes that will bring other thinkers from outside, people that will get paid by the fund and the board of directors of the fund for one day only. Doesn't matter what they say, only one day. They'll come, they talk at the board, and they go. People may say, Eureka, I hadn't thought about this. The second thing we recommend, among many others that go into how to create this tension, is to create a unit whose sole purpose is to scan for risks. And this unit will not be in touch with the authorities. So it will not have this problem of having to deal with the authorities. It will not be part of the regular business of the fund. So it will not be doing the regular surveillance and that. So my response to you is this is not an issue of developing new tools only. This is also an issue of creating a different culture and processes that make sure that you're not asleep on the steering wheel.
What are your thoughts on new economic thinking?
The different culture that Ruben is referring to needs to be born in the United States. Here's what gives me hope. I think the United States is like, well, the famous story about St. Augustine as a young man. Make me holy, honest, and chaste, Lord. Just not quite yet. At least, they know what they need to do. They're not ready yet. They have never been ready yet, since 1945. The way the U.S. adjusts its internal economic and political imbalances is by exporting the costs of change, right? That is, and we've all accepted that because it's part of the deal in exchange for the collective good that they provide, which is global security. Now we're in a new era, and it's about time for that period of chastity to begin. Okay, the rest of the world now and power has dispersed. So even the evolution of the MAPS process itself through G20 is an expression of the rest of the world saying to the United States, hey, wait a minute, we want a new deal here. If you're not going to listen to the IMF, maybe you'll listen in a smaller context. Now, it's still unrealistic. The idea that 20, actually, it's more than 20, with their deputies and with all the visitors in a set-piece room, that these people are going to listen to one another, and then they're going to go back and tell the U.S. Congress, we've got the advice from the G20. It's consistent with the advice that we're now getting from the IMF that has effectively combated groupthink. So now you guys do the right thing. Not realistic, okay? But it's the best we can do. All right, so the U.S. has signed a treaty. This gets to your core issue of legitimacy. The MAPS process is not quite legitimate because it's not universal. The rest of the world gives this advice, but now with a little bit of muscle that comes from China. But a China that wants to be part of the system. At that point, maybe things can change a little bit, and at least the U.S. could begin to understand the world that we were in 15 years ago. Not where we bowed to the IMF, but where we used the IMF and external advisors and good external advice to help ease the political process that we confront internally. I don't see why that can't apply to the United States. And as long as we respect China, there's no reason why it can't also apply to China on the other side.
Right. I think very, very good points. I mean, this comes back to the fact that we are in a paradigm shift. The world today is different than it was 5 years ago, 10 years ago, and it's going to be different 5 years from now and 10 years from now. And there's some major, major economic forces at play that are shaping that. I would like to touch on one last thing before we open it up to the audience, and it is, I think, linked to this legitimacy issue. And the dot I want to connect here, or the dots I want to connect, really comes back to the role of the IMF itself. And I don't want to get into the issues of the Articles of Agreement, but the conditionality around the lending to the Asian countries during the Asian financial crises received quite a bit of criticism from that part of the world. And I think we're still seeing some of the fallout from that. On the other hand, today we have the IMF lending money to bail out banks in Ireland, which I find very difficult to justify when I look at the remit or the mandate of the IMF. And so my question is, on the legitimacy side, is there a need, you know, in the context of the surveillance exercise and maybe how that's changing, is there a need, an underlying need to clarify the role and responsibility of the IMF? Because to some extent, I think that does spill over to the internal governance issues that the report points to, Ruben, that if the staff isn't clear about the remit of the organization they're working for, then that too can lead to frustration. So is there an underlying issue here around the role of the IMF as we look forward to this changing world that we've been talking about?
I think there is. Look, one of the ways to think about this, Paul, you know better than I because of all your years at the Bank of Canada. How are these impulses from the rest of the world are coming at the countries that are independent at the core of the system, these days mostly through financial markets. Right? So it's the financial markets plus an analytical process that is reasonably fair and not corrupt is, it seems to me, part of what the best we can do. But let's think about the Asian business for a minute.
Yeah.
This was extremely unfortunate. There was another IEO study on this. This is, it seems like ancient history, but to us in Canada, but in Asia, it's like it happened yesterday. Frankly, some of the advice that came to countries like Korea was outrageous, absolutely outrageous, and it was directly transmitted from Wall Street banks to the U.S. Treasury to the Korean authorities. It was over the line. It was over the line. It shouldn't have happened. Well, saying that, I think should be welcomed. Honestly, addressing that right now in an Asian regional context should be welcomed. If we don't do that, it should be welcomed by the rest of the world. That is, North America and Europe should be happy to go to the region and say, look, you know, things got out of hand, and we really believed in at that time the autonomous power of global financial markets. Well, you know what? We've learned our lesson. 2007, 2009. Sorry about that. We learned our lesson in vivid, bold colors. If we don't do that, if we're not doing that right now, then regional institutions will develop, and regional institutions in history have tended to become competitive with one another, and we don't need that. So I think we have a huge stake right now in in ensuring that where the money is, which is Asia, and especially China, is part of our system, and that we're all in this together. Now, that means some adjustment on their side. It means some adjustment on our side. It also means getting over, I think we're over it now, this kind of blind faith in the power of markets.
Ruben, your quick thoughts before I turn to the audience.
There is already a process in place to make China the third largest shareholder of the fund, I think by next year. And other Asian countries will see their shares increase.
That was a good thing.
And there is a process in place for reviewing that in 5 years that is likely to give them greater weight. It is possible, hard to tell, that will make them interested parties in the success of the fund. Our studies on the East Asian crisis, on the governance of the fund indicates that, not only this is seen as having happened yesterday, but the factors behind it are sometimes seen as happening today. So hopefully this process will, and there are some indications, will bring those countries to be engaged, have a stake in the institution, and make this universal institution truly universal.
Two quick things here.
Absolutely.
2 years ago, it was very plausible that China could have exited the fund. The fact that it didn't do that suggests that wise policy and reasonable, sound judgment on both sides is possible. On all sides is possible. But let me just say, there's one little thing that I'm actually, I don't know a lot about it yet, just starting to think about it. There's maybe this groupthink lesson that really jumps out of your study. It's very profound and very important. I'm not sure that it's really deeply accepted inside the fund yet. And one area where I'd go to look for an example of current groupthink is on the issue of capital controls. Frankly, the fund's position, which has shifted recently, to be consistent with actually post-2009 groupthink, now increasingly dominated, I think, by a certain way of thinking in the United States, because the U.S. needs capital to flow in and stay in. Otherwise, it really has a bigger problem with its own internal issues. But also this kind of sense in broader East Asia that, controlling capital movements is not a bad idea. That's now been a little bit legitimated by the fund. Well, we've had other periods in history when capital controls were considered legitimate, and those didn't end very happily. Those periods didn't end very happily. So I would just begin to think, I would wonder inside, when you present this notion of groupthink, I hope that people inside the fund would begin to say, okay, then where do we have some examples maybe going on today where we have some groupthink that we should be aware of? And maybe this is one of those areas. Maybe the pendulum has shifted a little bit too far.
Okay, I think we have about 15 minutes, so let's turn to the audience. You've been very patient. There are a couple of mics I see to my right and left. I don't know if Eric, your hand is up, so why don't you make your way to one of the mics? Or maybe, I don't know. Okay, speak loudly. Okay, yeah, we've got to think of our web audience, so yes, very good. Let's go to the mic. Okay.
So thanks very much. Really fascinating discussion, and particularly pleased to hear about this report and to read it originally. It's bringing out the political economy.
Could you identify yourself?
Sorry,
Some of us know you, but not everybody.
Erica Leiner from University of Waterloo. And it's bringing out the political economy issues, which I think are really important for the IMF to be studying. The one thing which I hope to hear a bit more about tonight, and which I'd be interested in hearing any of you speak about is the fact that some international financial institutions actually did quite a good job in predicting the crisis. And I'm thinking of the BIS in particular. And so if we're thinking about, what can the IMF do better, it strikes me, look at an institution that had a better predictive record in that particular area and think, what was it that went on in that institution that might have been more useful from the standpoint of the IMF's future? So I'd be interested in if your study explored that. Are there any lessons to be learned from their experience? And it strikes me one lesson would be internal, but the one that I think the IMF could learn a lot from potentially is the extent to which the insular culture of the IMF prevented it from listening to the BIS folks when they had certain warnings, especially in the macroprudential issues. So that's one question. The other quick question is, the one name that didn't come up today is the name of another top IMF economist, Simon Johnson, who makes an argument about capture, but it's a very different style of argument about capture than comes out in the IEO report, and that's an argument much more about the private financial sector itself, having been the central body capturing the U.S. Regulatory apparatus, but I think more generally the international financial community, the policy community. Mm-hmm. And so Lou brought it out in the context of the Asian crisis, and certainly most Asian political economists or economists that I know draw that parallel. What happened in 97, 98 was Wall Street had too much power over the policy process, and once again we saw it in the crisis like a decade later. So I was interested in why the capture was framed just in intellectual terms instead of the way Simon Johnson has tried to frame it.
Okay, I think we can collect a couple of, yes, please.
BIS.
I'm Catherine Hosteller. I'm a colleague of Eric's at the University of Waterloo and at the Balsley School that's being built next door.
Yep.
And my question has to do with part of your analysis of this past crisis, which focuses on maybe the excessive closeness of the fund to economic policymakers in the developed world. You talked about capture, you talked about the need to speak truth to power, you talked about a whole series of ways in which the fund really wasn't paying attention to possible dangers in the developed world. And it's quite interesting then in the context of yet another IMF official, Dominique Strauss-Kahn, and talking about his successor, that the European argument is that his successor should be a European because they will understand. And I would propose, maybe a little polemically, that perhaps one step towards moving away from capture and increasing the ability to speak truth to power would be to place someone from one of the emerging powers in as Dominique Strauss-Kahn's replacement.
Okay, thank you very much. Any other immediate questions? Okay, well, if not, let's turn to address those. Perhaps we could start with the first round of questions. Ruben, do you want to pick up? There's this issue of the BIS and lessons, both internal and external, and then this capture issue that Simon Johnson's been talking about. So perhaps your first quick responses to those. I'll turn to Lou, and then I'll give a couple of thoughts as well.
The BIS Secretariat, around a Canadian, Bill White, had been warning about many of the dangers that eventually developed. That was the BIS Secretariat, which was, like the IEO, independent. But every other month, they had the opportunity to speak to the governors. In that sense, they had a more direct access to the authorities than the fund staff, who only when they go on an Article 4, they speak to the governors, and only for a few minutes sometimes, while they have them as a captive audience. And two comments. One, they were not very successful at changing their views. And two, they were able to say these things because they were independent themselves from those authorities. So in that sense, they are further away from the G20 mutual assessment because they were truly independent, an idea that was given that was put on the table in the foundation of the fund, and it didn't really fully take on. But it was not the full BIS, but it was the secretariat, the economic units of the BIS. I will also say that there is an issue of luck. If you have a good thinker, an open-minded thinker in one place, independently of many other things, you may get...
William White.
The problem is that you cannot count on that. You have to have systems. And that's why we propose this contestability as a system. Hopefully you also get the right people, but on the second question, if you have the opportunity to read the report, I recommend it. I think it's a good report. You will notice that we are very candid. There's a quid pro quo here. We're given enormous independence and freedom to say what we found on a narrow issue, which is the effectiveness of the IMF, of its structures, its policies, but we don't deal with other issues. I've shared the podium with Simon Johnson on several occasions, and I heard his points, and they're not within the areas covered by the IEO's mandate. So that's why we don't go there. And I hope that you find that we are very candid about what we say about the capture of the fund by the authorities. The third question was on the selection of the managing director.
Yep.
And as I mentioned before, the IEO produced a report on the governance of the IMF, and there are copies somewhere in the back, where we have, first of all, we analyzed that. We have a specific study prepared on the process, an historical review of the process, how it evolved, and specific recommendations. And at the end, the bottom line is that it should be a merit-based process.
Mm-hmm. I won't disagree with anything there. I would just add a comment on this regulatory capture business. Mm-hmm. Look, as a political economist, Eric, you must be as surprised as I am. Actually, not surprised. Not surprised. We had a crisis. The crisis was accurately predicted by mainstream political economy, by mainstream political economists. Didn't have the exact timing, but I think that there was a general, there certainly is in your work and in the work of lots of our colleagues, a sense of the fragility of the system. We even, conventionally cited this ancient economist named Hyman Minsky, who was ruled unorthodox and uncitable by a generation of economists. And then comes the crisis, and suddenly people like Simon Johnson, who's a great economist, act as if he discovers regulatory capture. Regulatory capture, we're in late industrial capitalism, we're in finance capitalism. The idea of regulatory capture, we teach to our first-year students. That's the nature of our politics. Regulatory capture is politics in advanced capitalist democracies. That's the way it is. And in non-democracies, it's even worse. So here's the issue, and I think it's where the IMF tool comes in. It's not a radical notion that the United States financial system is subject to regulatory capture, and that has now had really terrible consequences, not only for the United States, but for the world. What can stand against that? Since the U.S. is not about to enter a new system called non-capitalism, called radically new American political system, what can possibly stand against the tide of regulatory capture? Well, the rest of the world. through a legitimate mechanism. In other words, look, Germany, Canada, and China, just to name 3 examples, are just as captured as the United States, but can they exert countervailing power bilaterally? Yes, but they're relatively weak. Can they exert relatively more countervailing power to, for instance, push us back to more, to push the United States, to help push the United States where it's probably going anyway, which is back toward a more rational financial regulatory system? I'm optimistic. Do they have relatively more countervailing power through the context of, through the instrumentality of the International Monetary Fund and its surveillance process? My answer would be yes. And I think that's exactly where we're at today. That's why I'm skeptical, frankly. I think there is more countervailing power coming legitimately through multilateral institutions like the fund than coming from relatively powerless institutions like the G8 or the G20.
Okay, a couple of thoughts from my side on the issues raised. On the lessons learned, looking at the experience of the BIS, a couple of additional points. On the one hand, in summarizing the work of people like Bill White, Claudio Borio, a great deal of emphasis being placed on the excessive credit growth that we saw through the period leading up to September, October of 2008. And I think a sense from these researchers that episodes of this sort in the past ended badly. The flip side, if you like, the argument on the other side, which I think came out in the IEO report, was again this groupthink around the tools that were being used, these models that really had no role for these real financial linkages. And moreover, the credit and the leveraging that was taking place didn't pose a big systemic risk because risk was diversified, that through securitization and other mechanisms, the risks that were associated with lending were diversified to the extent that you could not have a systemic outcome of the sort that we actually saw. So there were differences of view, and I think this is where a lot of the tension still exists in terms of moving forward, the groupthink that we've been talking about, the need for new economic thinking in terms of the tools that we use. I guess the other observation I would make on the same theme, IMF versus BIS, and to some degree it gets to the culture of the different organizations, and I believe it's important to remember that the IMF is a lending institution. It lends money to countries. The BIS is not. And I think to some degree the mandates of the organizations does reflect some of what we've seen in terms of the, let's call it the governance structure, internal as well as external, that Ruben has been talking about. On the capture issue, the only point I would add to what's already been made is I think one of the big lessons coming out of the global financial crises was flawed incentives that existed in many different jurisdictions. And on the regulatory side, the financial regulatory side, one of the critical issues is indeed to get those incentives right that apply to all financial institutions, big and small. And we're certainly not there yet. On the IMF appointment process, in many respects, again, it comes back to some of the key themes we've been talking about here tonight, which again is this changing world economic order. And there has been this tradition of appointing the managing director from Europe, the managing director for the IMF. And I think what we're talking about tonight is the need to rethink the governance of these global institutions, that the world is changing and these institutions need to adapt in light of that. And it's not an overnight change. It's something that we've got to work towards that's going to take 5, 10, 15 years. But the change will happen, and certainly there are some very strong voices out there to encourage that change sooner rather than later. Fred is standing up, so he wants to close. So first of all, let me thank you all for joining us here tonight. Very much appreciate you being here. The report, in many respects, looks back and tries to draw lessons out for the IMF, but our discussion really tonight has been about looking forward, and looking forward from the point of view of the types of analytic changes we need to make in how we think about the world, looking forward from a governance point of view, internal as well as external, and the tools of governance, whether it's surveillance or other mechanisms to actually encourage a better and stronger governance of the global economy. So thank you, first of all, to Ruben and Lou. I hope you've enjoyed the discussion. Thank you for joining us, and Fred, over to you.
Yes, thank you indeed, panelists. Thank you, Ruben Lamdany, Lou Pauly, and Paul Jenkins. We greatly appreciate your insights tonight into the global economic crisis and the role of surveillance. We did hear a very clear explanation of the failures that occurred in IMF surveillance. That did perhaps bring us to the brink of despair, but then we were helpfully inspired to remember why we have an IMF and how multilateral governance institutions operate for the good of the world, and left perhaps with hopeful ideas about some of the ways forward, either through additional groups like the G20, which might add muscle, or through shareholder reforms planned for the IMF, or even changes in the way leadership is selected at the IMF. All very interesting and certainly very topical these days. Just a few brief notes for our audience before we adjourn. The video from tonight's live webcast will be edited and posted to CIGI's website in our online video archive. Also, if you wish to sign up for CIGI's regular newsletter sent by email and called CIGI Worldwide, our volunteers are available at the back of the room to help you with that. And you can also find copies, printed copies or on CD, of the report that Ruben Lamdany led from the IMF. IEO. So once again, please mark your calendars for what will be a final public event of our 2010-2011 season, and that will be on June 21st. Join us for the annual media panel co-sponsored by the Canadian International Council with CIGI. Our topic is Muzzled Media, the Global Challenge. We have 5 excellent journalists, such as the CBC's Anna Maria Tremonti, all of whom are Canadians who have covered stories internationally, and they'll talk about dangers to foreign correspondents in war zones, including the risks of jail, torture, and even execution or murder. So please stay tuned to our events calendar at the CIGI website, including over the summer, as we begin to plan our fall lineup and register for our events newsletter. Thank you once again to everyone here and for watching our event at CIGI tonight, or if you're watching online, and please have a safe journey home. Thank you.